So, good morning. Welcome back to A Brief Account, our webinar series dealing with issues facing the accounts fresh indemnity market, where we will give you a bite-sized overview on key points. Today, we're looking at the ICAEW Professional Indemnity Insurance Regulations 2024, and we're also looking at the Accountants PII claim trends. First of all, some introductions. My name is David Gooding. I head up our accountants team. I'm joined by my partner, Liam Burnett. I'm also fortunate enough to sit on the Professional Indemnity Committee at the ICAEW, so I have a little bit of an inside track on the new regulations. I've also been involved in drafting these as well. We've only got 20 minutes, so we've got quite a lot to cover. And I'm, in particular, in terms of the PI regulations, just going to cover off some key points. And unashamedly, this is going to be very much insurer focused. There are a lot of other points that will be of probably greater interest to member firms. We will have a question and answer session at the end, and my very capable colleague, Giovanni Rowe, will oversee that. If we don't get through all the questions, we will do a follow-up at the end. So please, if you've got some questions, just drop them in the chat box as we go along. There will also be a survey at the end you'll see on the final screen. If you could just take a few minutes to complete that, I'd be ever so grateful. Thank you. Let's make a start. ICAEW PI regulations. Let's just look at some of the core changes. First of all, what's the purpose of these regulations? I think first thing I should say is I'm not specifically talking about the minimum terms of cover. So the minimum to the policies that participating insurers are obliged to adopt when providing cover to firms of accountants. The regulations underpin those minimum terms, but they are far wider than that. They provide a framework for which firms of accountants and members must deal with their professional indemnity arrangements. So they'll deal with how much cover they should have around excesses. They'll deal with run-off cover. What happens if they can't get cover and have to apply for a dispensation, or they have to apply to the assigned risk pool? So these regulations are quite extensive. I'm just going to look at a few key points that are going to be more relevant to insurers. So why change them? Why do we need to look at these now? Well, ICAEW perfectly aware that these hadn't had any real change since 2008. And there was a concern in particular around the amount of indemnity limit that firms were applying under the old rules, whether that was sufficient. And we've had a huge amount of inflation, certainly over the last sort of 5 to 10 years. So it was an opportunity just to have a good look at the rules and just to check whether they're fit for purpose and whether they needed to be updated. The review process that started off in 2023, that's been very extensive on behalf of ICAEW. There's been questionnaires. There's been a process by which stakeholders, brokers, members, insurers have had a chance to put forward their views. And then ICAEW in particular, the spearhead of this is the PII committee, have looked at proposals and then come up with proposed changes, which have then been approved internally. I think what's important to say as well, there haven't been root and branch changes. And in particular, there was quite a lot of pressure, I think, on ICAEW to make significant changes to the minimum terms, and in particular around run-off cover. So around whether that should mirror lawyers' minimum terms, in particular around run-off cover. So mandatory 6-year run-off cover to be paid whether or not the premium was paid. Quite a dramatic change like that hasn't happened. So ICAEW, I think, took a view in particular that they were concerned not to push capacity out of the market, which would have a consequence of increasing premiums, which would not be in the benefit of member firms, let alone the public. So there haven't been root and branch changes, but there have been some quite interesting changes. And the trio of changes I just wanted to quickly highlight with you today are around the increased indemnity limits, excesses, and group arrangements. Let's just have a look at those in turn. So the indemnity limits, the amount of cover that's required. What I wanted to just say first is there is an obligation, and it's hardwired into the regulations at 3.1. There's an obligation that all firms have got to take all reasonable steps to meet claims from arising in public practice. So whether you're a one-man band in Walsall to PwC, all firms have got to ensure they've got proper processes in place and finances to meet claims, whether that's through minimum terms cover or through wider resources, and those larger firms will have much bigger pots. So that's the starting point, irrespective of how much cover you are obliged to obtain. Let's start with this in the middle. So the majority of firms are going to sit within the minimum now of £2 million worth of cover. So if you are turning over more than £800,000 a year and less than 50 million, your minimum, and note the word minimum, the minimum amount of indemnity cover you need is £2 million a year. Now, that will either be on an any one claim, each and every claim, any one claim basis, or in the aggregate. It's quite rare to see these policies in the aggregate. That's not a change, by the way. That's been there for quite some time, that option. So it could be just simply £2 million in total for the year. Much, much more common to see this on an any one claim basis. So that's probably the majority of firms are going to sit in that middle bracket. And equally, they've got to decide whether 2 million is enough. For many firms, it's just not going to be enough. If you're turning over, say, 20 million a year, you're probably going to need a lot more than £2 million cover. But that's your baseline. And then at the other end of the market, the top end of the market, the big firms, that used to be regulated by how many partners or principals you had. Now we're looking at turnover. So if you've got turnover of over 50 million, you do not need to obtain minimum terms cover, but you've got to obtain appropriate cover in accordance with 3.1 that I just talked about. And I should say as well, when I talked about the £2 million cover, that's gone up from 1.5. It used to be 1.5, so that's gone up to 2. And then at the other end, completely other end of the market, the much, much smaller firms, so those turning over less than £800,000, there's a multiplier in terms of what cover they need, a multiplier of 2.5 times their fees. But there is now a floor of £250,000. So there is a minimum of £250,000. And that is quite a big change at the bottom, sort of the bottom end, the smaller firm end of the market. And the feeling was there just needed to be an increase. There was a real danger of underinsurance, even if a firm was only going to have 1 or 2 claims in its lifetime. There's a real potential that cover at, say, £100,000 or £40,000 was just not going to be enough. So that's the indemnity limits. I said there's going to be a trio. Number 2, changes around the permitted excess. So there's been some increases, and it's also linked now purely to turnover. Bear in mind, the excess does not include defence costs unless you're an FCA regulated firm. I'm not going to talk about those. So pure accountants firms under the minimum terms. Defence costs are not included. So in the rump of firms in the middle that I was talking about before, so if you are turning over more than 100,000, less than 50 million, your excess, so it's an aggregate, your total amount of excess payments in a year can be no more than 3% of fees. You can calculate excesses on any one claim basis, but there is a cap in terms of the aggregate over the year. So that provides for quite substantial excesses, certainly for the larger firms. It gives them a lot more flexibility than perhaps they would previously have had before. The much, much larger firms, 50 million plus turnover firms, they can deal with their own arrangements, as I've said before, and typically they'll have quite significant excess arrangements on their open market cover. And then at the other end of the market, firms now trading less than £100,000, there is a cap, fixed cap, £3,000 in the aggregate for the year. And there was a feeling that it probably shouldn't be more than that, largely for public policy purposes, just to make sure there was going to be enough cover in case those firms would struggle to pay a higher excess. The final real change that I wanted to touch on today is around group arrangements. So in the past, there was an opportunity for firms to apply to the Professional Indemnity Committee for a dispensation, stating that they were a group of firms and they should be treated as such for the regulations, and therefore say there were 10 firms and they grouped together for various reasons, and therefore they would argue that they didn't need individually to comply with the rules, but they could be treated collectively, and that was quite complicated. So what we've got now is effectively a codification of the rules around group arrangements. So if a group of firms comply with the criteria, then they just don't need to then, if they exceed certain turnover limits, they won't need to get minimum terms cover, qualifying insurance cover. So, for example, if you've got 5 firms and you added their turnover together and that came to more than 50 million, they can make their own arrangements. But there are quite strict rules around this, as you can see from the screen. So there are 2 mandatory gateways. Number 1, you've got to demonstrate common ownership, control, or management. Number 2, they've got to demonstrate that they are aimed at cooperation. And then the 3rd gateway, they've just got to hit one of these criteria that you can see on the screen around the circle. That might be use of a common brand name, for example, or it might be common quality control policies or procedures. They might share HR, they might share risk management, training, so forth. So if they can hit those criteria, then they can essentially be treated as a big firm and make their own arrangements. This isn't just going to be sort of Wild West. Firms are just allowed to go ahead and just do this without any sort of oversight. ICAEW are going to be monitoring this. We can come back to that point later if there are any questions, but there will be an oversight exercise through ICAEW. It'll be interesting just to see how that pans out. Okay. I wanted to talk about sort of practical implementation. So I said before, the regulations have just been published, by the way. I think they were published last week. There's a commencement date of 1st of September 2024. Now, for insurers who will, and firms, of course, will be undergoing a renewal before 1st of September 2024, the obvious question is going to be, well, what do we do? Do the old rules apply now? And then do we have to go through a second renewal in September? And the answer to that is no. So if a firm is up for renewal next week, the old rules will apply. So if they were within that middle rump of firms that I was talking about in terms of indemnity limits, they'll need to comply with a 1.4 million existing baseline. Once you get past 1st of September, that's okay. They won't need to go and get extra cover. When they come around to their 12-month renewal, the new rules will then bite in relation to the indemnity limits. But there is a long stop date of 1st September 2025, and that's to avoid some sneaky sort of 18 or 24-month extended longer-term policies. So that, and I appreciate, is very much a whistle-stop tour through the new regulations, and in particular, key points facing insurers. I'm going to now hand over to Liam, who's going to move the conversation on and start talking about claim trends in the landscape.
Thanks, David. I'm going to spend the next 10 minutes talking about claim trends against accountants before I briefly touch on the types of claim that we're seeing against insolvency practitioners. So this first slide that you can see on your screens provides an overview of the types of claim that we're seeing. But just to be clear, the information here is taken from claims that Mills and Reeve as a firm have defended against various accountancy firms, both large and small. But I think it's a fair representation of the wider market. Now, the first point I want to make is that whenever I've talked about trends over the last 15 years or so, very little has actually changed. So around 50% of claims arise from tax. Now, it's unsurprising because it's what accountants do. But tax is an extremely broad area. So it covers things like corporate tax. So this is advising companies in connection with, a possible restructure, a sale, or general tax mitigation. There can be claims that arise from personal tax advice. And it's not just the traditional tax planning around IHT and CGT, but we see claims arise from firms advising high net worth individuals and non-DOMs who have complex affairs. Generally, though, most claims arise because the return or a financial statement contains errors, or there's a late filing, and HMRC slaps down a penalty and charges late payment interest. Tax schemes are often talked about, they're always in the headlines, or they have been, but they ought to now really be a thing of the past, although we still do have some claims on our desk. Around 10% of claims arise from insolvencies, 9% from audit. The key point to make here is if you look at the bar chart on the right of your screen, although the claims arising from audit are low frequency, they're really high value. They're the claims you don't really want. Claims arising from probate or trustee work, we thought we'd see an increase here after changes to Legal Services Act, which opened up non-reserved legal activities for accountants like drafting wills and administering estates, but we haven't really seen anything develop here. And then the rest, around 13%, falls into the miscellaneous and other category. Generally, we're talking about volume claims, low value claims that arise from volume or process driven work. And I think we're seeing a slight decrease here because of the adoption of tech by businesses, bringing those functions back in-house and taking away that type of work from accountants. So that's the landscape. If we can just go to the next slide, please, David. I'm now going to talk about some of the trends that we're seeing. So here we see a selection. So picking up with R&D claims first. So this is where a business claims tax or a relief or expenditure credit for work that's carried on in projects that make an advance in science or technology for the benefit of a particular industry and not just the taxpayer's business. There are various qualifying grounds, the applications aren't straightforward, and the rules have changed several times since they were introduced. We've dealt with claims for a while, but we've seen a recent uptick as a result of HMRC's volume compliance approach. So what's happening here is that HMRC are now looking very closely at R&D claims. And I actually was passed a headline today, which said that 66% of R&D claims made by businesses in the media sector are being turned down. And HMRC is coming in with some real criticism for turning down claims that the industry thinks are genuine claims that should be allowed, but they're being turned down for basic errors, like things, like filing the wrong form. And because there are strict time limits, you don't have much time to correct a mistake when it happens, and there's no right to an appeal. So then the claim lands, and it's hard to challenge quantum unless there is a genuine reason why we can argue the claim would never have been permitted, but that is fact dependent. So the key takeaway for accountants here is to try and reduce their exposure by contracting on terms, firstly with the client, that makes it clear when the client needs to provide information and in good time to make the filing. And then secondly, accountants often rely on experts in this space. So the terms with the expert need to put the onus on the expert to get the application or advice into the accountant early enough to make the filing on time. Conflicts. Accountants are usually very good at spotting own interest conflicts, and they've got a regulatory obligation to cease acting when they arise. But we still see problems, especially where the accountant has a really long-standing relationship with the client. They know the client's tax affairs inside out, and it's very hard for the accountant to objectively assess whether they're the right person to deal with the inquiry. And sometimes this can make the situation worse for the client. Now, this is tricky, and I'm not suggesting that the accountant should simply walk away because an inquiry is opened. And most inquiries are open and closed without any consequences. But if there is an issue, and if one of the client's options is to point the finger at their accountant, then that's a good indicator for a walk away point. And we regularly advise on this type of scenario in a live situation as it unfolds, because it's so important to get this right. Tax. So when it comes to tax, one of the main drivers for claims, especially brought by SMEs and owners of owner-managed businesses, is where the accountant forgets that the personal interest of the owners/directors are not always aligned with the interests of the company. Now, the best advice for the company may not suit the owner's personal needs, and this has always been a fertile ground for claims, especially where by conduct the accountant forgets the division of responsibility and the duties that it owes to the company are separate from the duties that owns to the owners, and it assumes wider responsibilities and duties to one of them. And the key point to make here is just for accountants to constantly review what services they're providing against their terms of engagement and either expand or narrow the scope of what they're doing in the way that the parties intend. Moving on to audit. So as corporate insolvencies have increased over the last few years, so have audit claims. And we often see these claims brought by the liquidator or a litigation funder that buys the claim from the insolvent company. And typically, it's alleged that if the auditor had either identified errors in the accounts or provided a qualified audit opinion, then steps would have been taken at an earlier stage, either to avoid the problem or solve it, such that the company would have continued to trade, or if it was a really big problem, the company would have ceased trading at an earlier point in time, and it would not have continued to incur additional liabilities, which the claimant then seeks to recover in damages. Litigation funders, in my view, are driving this trend. And one of the things for accountants and their insurers to bear in mind is whether the accountant can limit their liability when they contract with the taxpayer, their client, as far as possible. And they can do this by seeking to agree a liability cap and possibly even including a term in the contract which prevents the assignment to a third party of any cause of action that may accrue to the client. Now, whilst the enforceability of these terms could be disputed, it's much better to have them than not. Finally, just one further point that keeps repeating in audit claims is that there's often a regulatory investigation attached, and that can often happen before the claim comes to fruition or on the back of the claim. And just to bear in mind that we are often instructed to help with those too. So talking about insolvency naturally leads me on to insolvency practitioners, and this really is a talk in itself. In fact, I did do a talk on this and IP's liability around a year ago on the back of a flurry of judicial decisions. The message here remains that the court is reluctant to interfere with commercial decisions that are taken by IPs. And this is really good news because IPs do have to make difficult decisions, often under time pressure and without the full information. But they must still exercise their discretionary powers as best they can whilst competing the interest of various parties, including potentially the court. It's a compulsory process. The claims that we're being instructed to deal with tend to arise when there's tension between competing creditors or between creditors and the directors/owners of the insolvent business. And in fact, actually, we've just recently struck out 2 High Court claims where the directors brought a claim as litigants in person against the IP. So it's really good news, and we're on the right side of this, but steps can still be taken to prevent or avoid the risk of a claim arising in the first place. What we always say is that when IPs have got an important decision to make, that they take independent legal advice or professional advice from the appropriate advisor in good time. And then when they make the decision, they try to step back and objectively assess whether that decision can be justified if questioned in the future. I'm just conscious of time. Looking at this last slide now, what is coming down the track? So nothing unexpected so far. The main risks that we see sort of coming to fruition arise from these external factors on the slide here. So political factors, what happens if a new government forms? Pensions are usually looked at, and whilst I'm not going to speculate what will happen, the key point is that if there is a change, either legislative or procedural, then that may cause a deviation from current practices, and that may result in an increased risk for insurers and accountants. The economy, things are looking better, but economic uncertainty is still there, I think, and that can create the risk of claims. But fortunately, I don't think we're contemplating the same level of risk as we did coming out of the pandemic. And then finally, tech. This is really big. Tech is changing the way that all professional service firms are delivering services to clients, and accountants are no exception. So there's some good news here because we've seen the introduction of fraud detection software that has, in my view, reduced the type of social engineering frauds that we were seeing and attacks on client account monies. However, the adoption of tech to deal with volume or process-driven work, which I referred to earlier, has caused work maybe done by smaller firms being passed back to the clients. And then those firms that have lost that work need to still generate turnover, and they're being forced to step up into the advisory space and take on more complex work streams. So there are obvious risks around that if the firm's not sufficiently equipped or experienced to deliver those services. And then finally, what are the larger firms doing? So the big four or top 10 are all talking about that, the AI, the generative AI, and the tech that they're adopting in the audit and regulatory space. We haven't seen yet whether that will present risks. We expect it will, and we're keeping a keen eye on it. I think that is probably taking me to the end of my section. And Jiv, I think if we've got any questions, now is probably a good time.
Yeah, thanks, Liam. We've had some really interesting questions through. We've got sort of 4 minutes or so. We'll go through as many of those as we can. If we don't get to your question, please don't worry. What we'll do is we'll circulate a crib sheet over the next few days, and that will have sort of questions and answers in there, so you can all have a look at those. So the first one, David, is a question for you, if that's okay. So you mentioned that the new rules, and especially in relation to group arrangements, will be monitored by ICAEW. How will that work in practice?
Good question, Jiv. And it'll be interesting to see actually what actually happens, because this is a new rule. My understanding is there will be some monitoring through the process by which each and every firm has to produce an annual return to ICAEW, and within that return there'll be discussion around insurance arrangements. So firms that have clubbed together under these group arrangements, no doubt when each firm produces its annual return, will specify that they are now complying with the group arrangements. They've got one collective insurance policy, for example, etc., etc. ICAEW will look at that, and I think if they have if the relevant department at ICAEW feels that there's an issue, that will get past the Professional Indemnity Committee, and I can have another look at it. I think that's probably the most likely way in which this will be monitored and assessed. But I don't think, this is from my perspective, I don't think we're going to have huge numbers of group firms. There's probably going to be relatively low numbers of firms going through this. So hopefully should be relatively straightforward to properly monitor it.
Thank you, David. Liam, the next one's for you, if that's okay. So the question is, do you think the adoption by accountants of AI is going to change the claims landscape?
So I flew through it, but I touched on a bit of this at the end. I don't know, the question was asked before I dealt with it, but I'm not going to repeat myself. But I think the adoption of AI is just going to change the way that accountants do their work. And I think it will inevitably result in change the type of work that some of the smaller firms do currently. And what we have seen already, we have seen some of the businesses that were doing payroll and the volume-driven process work lose that work because of the adoption of AI and tech, the client taking that back, and then try to sort of swim upstream and step into the advisory space. And we have started to see some claims coming through from that, largely because the firm probably tried to take too many steps too soon and lacked the experience to deal with it. So we are seeing claims arise already.
Brilliant, thank you, Liam. It's all really interesting. And I think that sort of takes us towards the end of the session. We did promise that we'd finish by 11:30 and have you away. So I'll hand back over to David to say our goodbyes.
Thank you, Jiv. And I understand, I can see there's a lot more questions being asked. So as Jiv said, what we'll do is Liam and I will go through those. We'll produce a crib sheet and provide feedback to all the attendees. So if you have asked a question that which clearly you haven't had a chance to answer, we'll be able to do that, and everybody will be able to see those answers as well. So forgive us with the time constraints. Thank you for joining us. It's been great to have a brief account back on the screens. We will be returning in the next few months, and I should be ever so grateful if you would complete the survey that will come onto your screen. It will only take you a few seconds, hopefully, in a few minutes. But thank you very much again for joining us, and we look forward to seeing you again soon.